Hey, how's it going, everyone? My name is Derek Afasi. I'm the owner of Afasi Financial Group. Today's topic, I want to discuss with you a two-tiered annuity and fully explain why someone might leverage two or more annuity contracts for their specific situation and kind of what are the benefits, what are essentially the cons to some of the annuity contracts, so you could really see through the fluff, see through the smoke and mirrors that annuity companies or insurance companies try to provide when they're offering annuity contracts, and then seeing whether or not it makes sense to utilize a two-tiered annuity or not. Now, when I say two-tiered annuity, you could leverage this with one company, you could leverage it with multiple companies, so it all depends upon your specific situation. The first topic I want to discuss is annuitization versus income riders for lifetime income. And the old school train of thought or the old school annuities used to always leverage something known as annuitization. And what that would mean, simply put, is that an individual would go take a lump sum dollar amount, throw it with an insurance company because only insurance companies could offer annuity contracts, and then that insurance company would provide them either a single lifetime income stream, a joint lifetime income stream, an income stream for a period certain, a certain amount of years, or like a life with a period certain, saying if they pass away within a couple of years, then their beneficiaries could receive back whatever the premiums that were owed. So many times individuals got upset because a family member would get set up in an annuity. They would only be utilizing annuitization. They say, yeah, I want to, kind of like how a pension plan works, I'm going to take my single life only option. So in an example, really quick example, a person would give the insurance company $100,000. Let's say this person's 65 years old and is a male. So the insurance company would say, okay, based upon your mortality tables, based upon interest rate environment, what we're going to do is we're going to provide you $7,000 per year for the rest of your life. So if this person took a single life only option, and he was to pass away after 2 years, well, the insurance company would have paid him a total of $14,000, but now the insurance company is walking away with $86,000. So because the insurance companies understand the law of large numbers, they understand how long statistically someone will live based upon something known as mortality tables, it would typically work in their favor. So if they have, millions and thousands of, different sorts of clients, some would pass away before that threshold, others might outlive it. And that was the benefit of annuitization, which simply say, oh, well, if I keep living and living and living and living and living, and what would typically be my break-even point, let's say if I'm living for 20 years, well, I would have gotten paid out $140,000 off of my initial $100,000 deposit. So it was just a big gamble. You're gambling against mortality tables. You're gambling against millions of dollars of actuarial tables, and that's why the insurance companies will typically win out on the deal. And this is why individuals have really hated annuitization, and there was bad press regarding annuities in the 80s, the 90s, the early 2000s. Well, now you have more innovative type of annuity contracts that say, we could allow you to have control. We could allow you to gain when the market's going up, or have your account value, still have access to your account value, to your physical money, and also receive lifetime income, but you're not triggering it through annuitization, you're triggering it through something known as an income rider. So it would be a type of account that's established through an insurance company, hence the word annuity in there. But you could establish this through a couple different ways. You could set it up on a fixed basis, where it's just paying you a fixed interest rate year by year. If the market goes up, you're getting paid that fixed interest rate. If the market goes down, you're getting paid that same fixed interest rate. It's going to remain flat and level. You have a variable account, which will go up whenever the mutual fund that was tied to that specific account goes up, but will also crash down whenever that mutual fund goes down. On top of it, variable type accounts or variable annuities also have a large amount of fees in there. You have the index, which will increase whenever the market index goes up, or gain 0% whenever the market goes down. So in theory, it should be gaining higher than how a fixed interest rate would work, or rather than a level percentage rate, it will either be a plus or be a gain of 0%, a plus or a gain of 0%. So with those types of accounts, and those are just some three very generic types of annuity contracts, you also have a bunch of other ones out there, you could attach certain income riders to those types of accounts. So what I mean by that is, in the same example, let's say if a person's age 65 and they give the insurance company $100,000, and let's say they were set up in a fixed index annuity with an income rider, which is also known as a hybrid annuity, this individual can go and say, okay, $100,000 is now sitting in my account value, My income rider, if I want to trigger lifetime income right now, maybe the insurance company is going to pay me, $6,500. Not the full 7,000, but maybe it's $6,500 for this male age 65. So therefore, if he keeps living and living and living, let's say he passes away after 2 years, well, the insurance company would have paid him out $13,000. And let's say all things being equal, there was no gain, there were no losses to this account. Now, what's remaining in that account value is $87,000. So rather than the old school type of annuities through annuitization where you would lose all control, $87,000 can now go to the beneficiaries, and they could leverage that as now a death benefit. Also, as this person siphoning out the $6,500, if he ever comes into some sort of scenario where he wants to pull out some money, well, he still has his money sitting there. It's still sitting in an account. He did not force his account to go into annuitization. So there's a large difference there when you're looking at lifetime income through the form of an income rider or lifetime income through the form of annuitization. So those are going to be the most important aspects on how to understand the cash flow aspect or the lifetime income aspect with these specific types of annuity contract. So when we're looking at the benefits of a two-tiered annuity, we have to understand which favorable options or which favorable benefits on a lifetime income basis are being paid out. Some carriers work really well if you're looking to trigger income immediately. Other carriers have the best options or the best cash flow percentage when you're looking to defer 5 years or 2 years or 4 years, etc. So if we have an individual that's age 60 and he wants to retire at age 65, well, understand that at age 65, there's going to be a specific dollar amount or specific cash flow. So if you're using $100,000 as your original deposit, maybe company A at age 65 might provide this person $6,500 per year off of that original $100,000 deposit. So this is now broken down into something known as a 6.50% cash flow. Each dollar that they're placing in, if they defer it for 5 years at age 60 to age 65, based upon either that male or female projection, 6.50% of that dollar at age 65 would go, would get paid out. As opposed to company B, which might offer a 5.40% cash flow, or $5,400 off of that original $100,000 deposit. So therefore, company A is going to be a much better option as opposed to company B for somebody that's 60 that's looking to trigger income at age 65. Now, where company B might be a better option is, let's say at age 75, the cash flow percentage off of B might be 12%, meaning the original $100,000 deposit that you placed in there at age 60, at age 75 will now provide you $12,000, as opposed to company A, even though they were very favorable with a 5-year deferral, well, then maybe they weren't very favorable for a 15-year deferral, and this cash flow might only be 10%. So there's ways on how you could leverage those cash flow percentages. There's ways on how you could leverage the best possible contracts out there that's looking to trigger lifetime income as opposed to just going into it blindly. One of the things that I always mention, as I say, you never just want to hear a marketing piece and say, oh, I heard about this great annuity. I was sitting at a seminar and I want to go and place my money into this specific type of annuity contract. That's essentially shooting yourself in the foot. You do not want to do that. You want to make sure that you're leveraging the best possible criteria for your exact age. So whenever we set up 2-tiered annuities or 3-tiered annuities or 4-tiered annuities, what we want to do is try to set up a laddering strategy specific to what your income plan is. If you have a specific income goal where you understand, in this example, I'm 60 years old, I want to retire at age 65, or I'm 60 years old, I want to retire at age 62 or age 70, whatever that case may be, there's going to be an excellent company or a specific company that is going to be in first place over hundreds of different options out there. So why would you go with something that could come in 20th place as opposed to something that would give you the most amount of leverage possible at age 65? Now, when it hits age 75, understand that when somebody's in retirement, they have certain expenses at age 65 or whatever that retirement age is. You have a portion of fixed expenses which are always going to be flat throughout your entire retirement, and you also have inflationary expenses. So these are things, the cost of goods and services increasing by average about 3% per year. So if somebody has inflationary expenses, which everybody does, at age 65, yes, it's going to provide them a flat lifetime income, but maybe at age 75, whatever they're receiving as lifetime income is not going to cover their expenses. So that's why you might need that second tier to get triggered at your age 75 or age 72 or whatever that case may be. So essentially what we try to do is stack up laddering strategies to make sure that first and foremost your income sources are covered. If you're receiving Social Security income, if you're receiving pension income, and if you have now retirement savings, and you need that as that third portion of income to cover what your expenses are, we want to make sure that you are confident in retirement and that your income sources are completely covering your expenses. The number two is making sure that you have ample amounts of emergency funds in there. You want to make sure that worst case scenario, you have about 6 to 12 months worth of savings. The way to have this maximized is by leveraging the smallest amount of dollars into one of these types of annuity contracts or guaranteed lifetime income contracts to suffice that income source. So in this example, you have X amount of expenses, but you have $500,000 in retirement savings. Maybe it's only going to cost you $100,000 to accomplish that goal to make sure your income sources are covered. Why would you go and place all $500,000 into an annuity? You want to make sure that the annuity is serving its purpose. It's like an individual tool in a tool belt. So this is why you could leverage the best types of guaranteed insurance contracts, guaranteed income contracts out there, such as an annuity, that one would be triggered for a specific set of age, and then a secondary, known as a laddering strategy, could be triggered for a later age, because that cash flow percentage is going to be more ideal than the first company. And that's the way of using the best income streams to maximize your retirement monies. The third source, or the third aspect that every individual needs to have to make sure that they can properly retire or understand that they're going to stay retired forever, is that inflationary protection. Yes, we might accomplish your goal at age 65, but what happens later on in life? And that's why a two-tiered annuity is very is very important, or at least understanding what the cash flow percentages are of these annuities, rather than get caught up in the fluff, rather than get caught up in what's a premium bonus, what's a 7% guarantee, because all of that is just a marketing ploy. It's basically a marketing ploy to say, hey, listen, we want to try to confuse you as much as possible so that you're going to go and place money with us. You're not getting a true 7% guarantee. You're not getting a true premium bonus on those monies majority of the times. So that's one of the things that we try to do, is we want to educate you first and foremost. We want to make sure that you understand exactly what your income sources are, what your current situation is, what are some of the gaps with your current situation, so that you could accomplish your goals successfully. So at any point in time you found value in this video, simply give our 1-800 number a call. It's 1-800-566-1002. We offer 24/7 customer service, so we'll always have a specialist standing by to help answer any of your questions. And just give us a call. Say, hey, listen, I saw the video online about the two-tiered annuity. It sounded interesting. Maybe it might help out my situation. Maybe it might not. So what we're going to do is we're going to provide you with literature pieces. We're going to provide you with personalized videos, different sorts of education to make sure that you could fully understand these things and see if it will apply to your specific situation. We are A+ rated on the Better Business Bureau. It's because of this methodical process. So we're located over in Florida, but we deal on a national basis. In order for us to stay competitive on a national basis, we have to make sure that our education is bar none. It's basically, you guys, with any sorts of retirement plans, you only have one chance to get things done correctly. You can't make any sorts of mistakes. So you have to understand what your plan is, what your current situation is, what your goal is, and then how a plan might suit your specific needs. So, we've had a lot of success throughout the years in doing that and helping individuals out. And, at any point in time, feel free to subscribe to our YouTube channel, Retire Sharp, so you have access to the most updated videos. And, whenever you're comfortable, just give us a call. Once again, that number is 1-800-566-1002.